One of the biggest mistakes you can do is not understand the time frame that you trade. You can come in with the intentions of being a day trader, but coming from a long-term investor mentality and culture and experience. And at the same time, you are a day trader approaching it as if you had a long-term horizon ahead of you. And when traders and investors confuse their time frames, that's exactly where the loss occurs. This is also the reason for very prolonged recessions, but I'm not going to get into this right now because it requires a discussion of its own. What I do want to emphasize is that as a trader and as a short-term trader, you need to understand the time frame that you trade. Meaning that when you are a day trader, you do not pay attention to news that say that the long-term trend is overbought. Or if we are in, for example, if we were to go into a deep recession or correction that the times occur, you shouldn't care, what the news say about, the territory being oversold. And the reason is because you don't care as a day trader on a daily basis where the long-term trend is. You just shouldn't care. The problem occurs is that when day traders are affected by the noise of TV saying the Nasdaq is too high, or the Dow is too high, or the E-mini S&P is too high, right? Or as they don't refer to it on TV as E-mini, but just the S&P contract, the cash contract. And that puts the short-term traders in a state of mind of approaching the market as an overbought territory. I'm specifically talking nowadays, right? Because we have those indices that seem to striving to make new highs every day, and then at the same time there are people who are coming in and saying, well, this is all as a result of retail traders coming in and small time traders that are just adding to the market momentum. The issue for the day trader should be, well, if that's the case, that's where I should trade. I should trade, as the market dictates, on a day-to-day basis. And just because the market reached a new high, it does not mean that you short it. And just if the market reached a new low for the week, it doesn't mean that you buy it. You just trade with the trend for the same day. That's really how you should treat this market. So every day you don't look at where it was before and not trying to guess where it's going to be tomorrow, but rather trade it right now. In reality, what happens is that short-term traders get confused that they're investors. So they get affected by the news, the market makes new high, and they short it. They're like, okay, well, I think the market is overbought. Well, it could be overbought, but it's not overbought for the next 5 minutes, and it's not overbought for the next 15 minutes. It could be, but it doesn't necessarily mean just because the market is high, it's not going to make new highs again. So again, your goal is to trade with the probability. The same thing that happens on the downside. If we go through some corrections and the market starts to hit new lows, you don't get into the mentality of, well, the market is oversold. You just trade as a day trader what the next trend is for 5 minutes, 15 minutes, 30 minutes. Obviously, as a day trader, those are the time frames that you're looking at. Now, specifically, when you trade leverage products such as futures, whether you trade the full E-mini S&P or you trade the micro, you're trading a sophisticated derivative. It is not an investment. people who engage in leverage, and any type of leverage, even if you take leverage on equities, you trade futures, stock indices, you trade forex, any type of leverage that you're involved, in my personal opinion, you're outside the realm of investing. Now you're in the business of trading. So you have to trade what the trend is currently telling you, what is happening right now in the marketplace. One of the reasons that we sometimes have huge corrections and people suffer is actually when the investors are coming in, looking at the day traders and saying, oh, I see those gain on a daily basis, and then they come into products such as futures, trying to trade it for the long haul or anything like that, and then you have huge corrections which affect your cash substantially because it's a leveraged product, right? So it happens to both investors and day traders because they don't know that what time frame that's actually trading, meaning that they, in their mind, they're set one way, but they actually do have expectations of a different time frame. So it's important to understand that when you are a day trader, there will be a lot of noise in the marketplace. That's what it's all about, right? You have ups and downs and fluctuations and everything else. And part of that noise is the price that you pay for being in the futures market. That hesitation, the psychology, the ability to withstand those fluctuations as they occur, that's just part of the cost, of being in the marketplace. You have the cost, of course, the transactional cost, but then at the same time, you also have the fee and the cost of your behavior in the marketplace. I mean, the way you are getting affected psychologically by those fluctuations. That is part of the price. And this is what you have to accept in order to understand the time frame that you trade. Long-term investors will also have huge fluctuations in their equity. If you look at any, equity type product, any of the big companies, for the last, let's say, 10 years, if you were to gauge their fluctuations, you would see that they also have very highs and lows and big drawdowns, sometimes 50%, sometimes even more than that, depending on the equity product that you trade. So they also have to live with it, but on a longer time scale. You, as a day trader, have to live with it on a shorter time scale. So if you're a day trader, set parameters for day trading. And if the market is high and you get a signal to buy, you buy. There's no way around it. I mean, to catch, tops and bottoms in this business is nearly impossible. So if you're coming, after being influenced, watching some show on TV or you read some report where the market says, well, this market is overbought and there's a lot of young people who are buying it and everything else, then you're looking for opportunities to short it psychologically like an investor, because that guy on TV doesn't know your time frame. He doesn't know that you're looking at 3-minute charts, right? So you're trying to take an advice of somebody. He might be right. I mean, he might be right that in the next month we're going to go through some correction, but it doesn't mean that it's going to happen in the next 30 minutes, 15 minutes, 5 minutes, whatever time frame you trade. So the isolation of the time frame and understanding the time frame that you trade is very, very crucial. The shorter time frame that you're looking at, you will have a lot more noise associated with it. So if you go from 1 minute to 3 minutes, 5 minutes, 15 minutes, 30, 60, you could be a day trader looking at an hourly trends, which is fine too. But understand that, you are trading that trend of 1 hour, 15 minutes, or whatever you choose. You're not trading the trend that came from yesterday, and then you're not trying to guess where the trend is going to go tomorrow. It's now. You're not an investor. So I hope it helps you in terms of understanding. So sometimes I feel that traders are intelligent, and some of the concept that I explain here, they know about it, but at the same time, I'm trying just to make you a little bit more conscious, of putting a little bit more precision into your trading. One of the biggest mistakes, and I'm sure that I've mentioned it to a number of you if I've spoken to you in the past, is when you're a day trader and your day trade did not go so well. And now what you're trying to do is basically trying to leave a position on, trying to see and recover the loss. You're trying to see if you could recover the loss if you were to carry the position overnight. And that's exactly where the problems begin. First of all, if you're a day trader, in my personal opinion, you should close your position every day at the end of the day trading session. Now, if you want to restart after the market reopens an hour later, as you know, the stock indices, majority of you probably trade stock indices, but even if you trade crude or gold, all close at around 5 o'clock Eastern time, 4 o'clock Central time. And if the market reopens after an hour and you want to be in it, it's fine, you can trade it. But if you're a day trader, you should really close your position, because that hour gap of the market being closed in that 1 hour, a lot of things can happen. So as a day trader, you want to avoid uncertainty. When the market closes, the world doesn't stop. The market, if you had a little loss and you left the position on, trying to open recover, the market could even give you a much bigger loss. If you stay in at a trade, in a trade, when the session actually is closed, meaning that you left a position on to try and recover, let's say a position that was left overnight, try and recover maybe a loss that you had throughout the day. That's what I mean to say. Sorry, I'm trying to get my focus together here. So you had a loss, you're trying to come into the market, and you're trying to recover, and you left it. That 1 hour could cause a lot of damage. And this is exactly where you're starting to confuse the time frame that you're trading. And it goes same for wins. If you had a win and you left the position on at night for the nighttime, again, you left it 1 hour open. Now you changed, your role as a day trader, because as a day trader, you have to manage your risk. It means day trader, day session, it's closed, it's done, everything else. Some people could argue back and forth about, if I had a winning position, the trend is strong, I want to keep it overnight. And if I had a loss, it doesn't mean that the market might not come back, and give it to me. In both situations, of course, I don't have a crystal ball. Anything could happen. You could be in a loss and it could turn into a win in the night session, or you could be in a win and it could, and it could turn into a bigger winner. But this is not the sort of behavior, pattern, and habit that you want to develop, because I believe in the long run, it will hurt you. There were many traders out there that says, I'm just going to do it this time. Even though you're listening to me here and you're saying to yourself, I'm not going to do it, only the market will put you at a test. And many times I could tell you that people have stayed in a trade, instead of looking at new opportunities, they stayed in a trade for too long, not confusing their time frame again. From being a day trader, they stayed in the market for a number of days, and a big loss just ate their account. And again, in the business of leverage, such as futures, precision is just about everything. Methodology, risk management, everything else. Every single contract you trade is a very big contract. It's leverage. So you're trading something with a very big magnitude in terms of the financial impact that it has on your equity. So what you want to do is basically, again, as I said, understand the time frame that you are trading, understanding what you should do within this time frame, what you shouldn't do, and above all, having the right psychological mindset for short-term trading. Again, short-term trading is not necessarily thinking about the long-term trend that was there for the last week, because you're just trading the current fluctuations. Now, the other side of the coin, just to be fair, that what some people may say is this. We look at bigger time frames. We look at the daily, I look at 30-minute, and I look at 60 and 60-minute, and then I trade off the 5-minute charts. Fair enough, right? If the trend, on a number of time frames and the bigger time frames appears to be going up, then obviously, okay, I get the point. Or at the same time, on the downside, if the long-term trend and the short-term trend, everything is going down, as a day trader, your probability in your head is that you want to trade short. That is fine. I get it. Nothing wrong with making long-term charts as a reference. What I'm really referring to, more than anything, is the length of time that you stay in the market as a result of that trade. Whatever made you get in is fine. But at the same time, if you start treating your day trading as an investment, then again, in my opinion, that's where the balance will be reflecting that, and not in a good way. So, as I mentioned before, I think on previous podcasts, you use the time analysis as a variable. So let's say you're trading a 5-minute chart. Now you're in a trade for 4 hours and it's in a loss. Well, I'm not saying you turn into an investor, just because of 4 hours, but clearly you're breaking the rules of trading 5-minute charts and being in the market for 4 hours. If within the next 3x, meaning 15 minutes, 20 minutes, your setup didn't work out, you have to move on. So it gets very, very specific when it comes to time frames. And I think if you are coming as an investor to day trading, just keep that in mind. Whatever you did as an investor will not apply as a day trader. If you're a day trader that one day turned, that maybe some of your other capital is a long-term investment, you cannot do the analysis on your portfolio the same way. You could be very, very long-term on an equity company, on a stock, thinking that it's going to make new highs, that it has great management, a good product, and a revenue, but you could be potentially short the stock indices. Let's say there's some company out there, there's a big chunk of the, of the stock index. There's nothing wrong with being short term on the stock index where your portfolio is long something. In my opinion, there's nothing wrong with it. In fact, now you're treating both assets as it should be. A leveraged product is a short-term product, and your equity, which hopefully you don't use leverage on it, is more long-term. So that's what it is. Now, the last point that I'm going to address is that there are people out there who are trend followers. And they would say, well, what about trend following? And they would swear by trend following, right? Because they would say, you can take a leveraged product and basically ride it. Look, theoretically, trend following exists, but most of it exists on hindsight. It is extremely hard to hold a leverage product long term. I'm just saying psychologically, it is very, very hard. Sure, you can look at something like the gold that came in the last 2 years, maybe from, I think it went from like 1,200 to 1,300. Check your charts. I don't remember exactly, but it scaled all the way up in the last 2 years to almost 2,000, a few weeks ago. And you say, well, if I traded this long term, then sure, I would have made it. Now, okay, fine, you can make that argument, but I'm saying that there's not a lot of people who can actually hold a contract that long because of the fluctuations that occur and the huge corrections that occur. We were almost at 2,000. We corrected $150 or something like that, and that those fluctuations of $10,000, $15,000 per contract, those are huge fluctuations. So I believe because of the algos that we have, the HFTs, the huge quantities that come from institutions, they make it very hard for the average person out there that approaches futures with risk capital, and you should be trading futures with risk capital to withstand long-term fluctuations. So it is better if you are a short-term trader to learn how to use the parameters of short-term, use the risk management of short-term, block your ears to bias. And let me tell you this, it is extremely hard to block information coming in, because you read it and it could come into you when you're subconscious, right? So you went long somewhere and you're thinking it's going higher, and then it just starts going down a little bit against you, but still you can maintain the position. And then you're saying, well, this guy said that it's overbought, so maybe I should sell it, right? And you sell it and then it goes back up. What you want to do is really be independent of that noise out there. As a day trader, focus on your methodology, close the positions at the end of the day, and hopefully that will put you in a better position. I wanted to thank you for listening. Just to remind everyone, there's a substantial risk of loss in futures trading. Past performance is not indicative of future results. Please use only risk capital. Don't risk capital you can't afford to lose. It does not feel good when you lose money that you can't afford to lose. So stick and learn with capital that you can. Some of you have more risk capital, some of you have less risk capital, some of you have more experience, less experience, depending on your risk appetite. Also, determine what capital you want to operate with. I wanted to tell you that I look forward to servicing you at our company, Optimus Futures. You can find everything about us at www.optimusfutures.com. We look forward to your emails or any questions you may have. You may call us at 1-800-771-6748. If you're outside of North America, it's 561-367-8686. We have great staff, and we all are going to help you, and we do look forward to helping you. If you're with someone who takes your business for granted, you haven't established a relationship with, we would be more than happy to replace them anytime. That's it for now. I wish you a good day and a great week, and I look forward to our next podcast. Thank you. Bye-bye.